playbook for portfolio management has shifted. You better be ready. I'm Mike Smith, and welcome to the Lowdown. Well, I got a special guest, Kevin Lenox. Kevin, welcome back. How are you doing?
Good. It's been a year, hasn't it?
Has been quite the year. A lot has changed even since last time you've been on.
Yeah.
But I thought, well, let's kick off the show and let's be brief. But something did happen, and I thought maybe just in a quick minute you could summarize what happened with the Federal Reserve meeting.
Sure. So the Fed raised interest rates as expected by 75 basis points. And in the presser afterwards, which has always been an adventure this year, I actually thought Jay Powell did his best job yet.
Okay.
In that this Fed has been ex post. So therefore, the market is a discounting mechanism. The market's been leading the Fed.
Correct.
And financial conditions in particular have been whipsawing and basically leading the Fed. And Powell complained about that yesterday. But it's their own doing. It's basically been whack-a-mole.
Well, he's been known as Pivot Powell.
Right. So we go back 2 shows, I guess, in the early July show. Then financial conditions had tightened so much during June. Then in July, I said, this is too much. Something is about to break.
Yes.
Look for a pivot. And then sure enough, they did pivot. And then between the end of June and mid-August, the S&P 500 went up 14%. That's not what they wanted.
Correct.
And then at Jackson Hole, Powell walks it back. No, we are going back to 2% inflation. We are raising rates as much as necessary. And then financial conditions tightened again. The market went down. And then just 3 weeks ago, they start jawboning again about loosening up. And
market reacted.
The S&P 500 was up 8% just in October.
And they don't want that.
Don't. And he talked about that for the first time, really. So he said, now we are going to have to go higher than we previously expected and probably hold them for a longer period of time, and trying to send a clear message and get control of the narrative, which I think he did a pretty good job at. We'll see. But they are likely to still sort of whipsaw between financial conditions tight, might need to loosen, or loose and then have to tighten down. But we are approaching probably the end point of rate hikes within the next 6 months.
Agreed.
And we'll see we go from there. So the market has been looking to jumpstart and get excited about this pivot or pause in rates, but I'm not sure a lot of people have thought about the consequences of what would cause that, namely margin compression, weaker earnings, and a consumer that is getting weaker seemingly by the month.
Well, let's go on that because one of the things I want to talk about was margins, right? I mean, up until now, most companies have been able to kind of pass along the higher costs to consumers. As a matter of fact, some companies have actually kind of built in wider margins by doing this. But you've talked about now a weaker consumer, and going back to the Fed for a moment, what they're trying to destroy is the wealth effect, right? If the markets come down, my home price comes down as a consumer, which drives 70% of GDP. If I stop spending, that's a pretty big deal. I mean, look at durable goods. You saw the fastest inflation, now deflation in terms of durable goods. And if the consumer starts to slow down, that now gets into margins.
And one of the areas that I look at, as you know, credit, the index and all, but the disparity between the credit-sensitive companies. So you look at American Express, deals more at the high end. I think their stock is only down 11, 12%. You look at Capital One, who focuses more on subprime, they're down about, I think, 30%. And Ally Bank, which is more subprime, down like 45%. So you're seeing this division between companies that are getting impacted by a weaker consumer. Companies like Pepsi, United Health, McDonald's can pass along the price increases. So a theme I think we've had for months now is focus on quality companies and those that can pass along price increases, because those that can are vastly outperforming those that can't.
Well, you're having a big disparity in terms of seeing, growth versus values we've talked about in the past. Well, that kind of gets me into the topic. We talk about the playbook for portfolio management. I think most investors understand the 60-40 stock to bond portfolio, And that's kind of been your staple for just a good old balance. You know, if you didn't want to take a lot of risk, you just wanted to go kind of middle of the road, that was the choice that many people went with. It was kind of the weather-all portfolio of stocks and bonds. But here we've had now the worst start for bonds in history, and I think now the fourth worst start for stocks. What's happening with the 60/40 portfolio?
Yeah, it has been decimated. And, you know, well, a big part of it is when you go from 25 basis points at a Fed funds rate to 4 since March.
Yeah.
After that, following a period where we've had over a decade of volatility suppression, price, suppressing price discovery for 10 years, it's going to have an impact when you just rip up that playbook. And it's been accompanied by quantitative easing, basically zero rates around the world. Then it has a big impact on that. So that's the impact on the bond side. And then the flow through on stocks, then we've seen then longer duration type of stocks. So such as the FANG stocks. So the Metas now used to be Facebook. Apple, Microsoft, they had grown to be 25% of the S&P 500.
Wow.
And when you have interest rates go up, that is a direct headwind to growth companies. Those companies are based on long-term earnings projections at a discount rate, a risk-free rate. And what happens when that risk-free rate goes up with the Fed funds rate, then the valuation looks that much more expensive. So the growth stocks, which have just been dominating the S&P 500 from a market cap perspective, have down, I think, about 35% on the year. And the S&P 500, I think, is down 21%.
You're correct.
Value stocks only down 6%. So what we've done is focused more on value companies within that quality constraint we talked about before. And we're seeing the best outperformance versus the 60/40 benchmark that I can recall. And this is an era where you're going to have to actively manage the portfolio. On the equity side, it's going to be more of a value tilt going forward. And on the fixed income side, manage your credit risk. And when rates are moving up, you need to be on the shorter side of the duration spectrum.
Well, let's just define maybe for those that don't know, active versus passive management.
Sure. So we run core satellite models. And I've run that model for years. So you have a portion of the portfolio that is just, let's just call it the 60/40. The stock bond mix varies by client. But the idea is that you have some majority of the portfolio in just very, very low cost ETFs just to get the broader allocation. And then depending on the client, tactically manage. So we think, energy has been, as you know, one of my big areas for the last couple of years. Then overweighting energy is a tactical tilt. Overweighting value is a tactical tilt.
So that's remaining active.
Correct. Actively saying, what part of the market do I think can benefit from this environment and overweight that area? And what areas should I avoid? And on the bond side then, having cash, T-bills for some, overweight short-term bonds are less sensitive than intermediate longer-term bonds.
So move across durations.
Exactly. So you have to pay attention across the asset spectrum and go, where do we want to be in this environment? And something we always talk about in all our calls is the business cycle. Where are we? What do the leading indicators point to? And how should we allocate? So those tactical tilts mean more now than they have in years.
So where we are in the business cycle, looking at where 40 years of low inflation, now moving higher. We've got, liquidity provided by the Fed being accommodative. That's changing. All that's shifting and moving more towards a portfolio that needs to be probably positioned more actively than passively, what we've seen in the past.
I think we are separating the men from the boys in portfolio management. And people just keep kind of chasing after returns and, remembering where returns were. And now we're seeing, honestly, I think there's a clear shift in rotation from the tech stocks to energy. I think we shared a chart earlier this week showing energy stocks basically moving in tandem or very highly correlated with Brent. And then in the middle of this year, Brent moved to the downside. The XLE, the energy sector, kind of traded sideways and now is shot up in a complete divergence. At the same time, the tech stocks have really rolled over hard. So that's an example of something that has made a big difference in portfolio returns over the past couple of years.
Well, Kevin, thanks for shining some light on this. I think it's been very helpful, and a lot is changing. And I think we're going to be here to help guide everyone through. And as always, if anyone has questions, comments, they can get by the website and get by our channel, and make sure you like and subscribe. We'll see you guys next time on The Lowdown.